Hello there, everyone. Good evening. I have at the time is 5:30, so we're just about to get started. Hopefully you can see my screen here and see my two presenters as well with me. I'll give just a few more moments while everyone loads up, and then we'll get started. Thank you so much for joining. All right, everyone. Good evening, and thank you for joining Desert Botanical Garden for a very special webinar, Growing Your Year-End Impact with Insights from the Experts. The date is November 24th, 2025. It is the perfect time to consider your giving impact before the calendar end and busy holiday season. My name is Olivia Homewood. I'm the Director of Development for Individual and Plan Giving here at the Garden. Our agenda for the next hour will cover the various types of giving vehicles one can utilize for charitable giving, as well as the breadth of impact made by donor generosity. I will then introduce our fantastic speakers who will share insights on charitable deductions for itemizers and non-itemizers, and offer strategies that may impact your taxes while deepening what can be accomplished with your investment. We will additionally share example scenarios and answer general questions on these helpful charitable tools. Questions are welcome at any time and will be answered at the end. I will note that our speakers cannot offer legal advice to non-clients. That is according to professional conduct rules set by the bar, nor can the garden offer legal advice. So as always, please consult your own advisors for tax and legal matters. Next is some quick housekeeping. Please know that this presentation will be recorded, is currently being recorded, and all slides and materials will be sent via email following the presentation. The chat function should be available now. I will make sure it is. There we go. And it will be disabled during the presentation. To ask a question, please use the Q&A function that's at the bottom of your screen. This helps organize the questions being asked and is available throughout the entire presentation duration. Now, to address some jargon before we get in too far, what do we mean by charitable planning? What is planned giving? Simply put, this term in nonprofit and philanthropy speak refers to donating non-cash assets to charitable entities. Many people give donations of their liquid cash by mailing a check or giving from their debit or credit card. But like the expression work smarter, not harder, you can also give smarter through non-cash assets you own, like stock, retirement assets like your IRA. That's especially smart if you're over 70 and a half. Real estate, retained life estates, life insurance, charitable trusts, cryptocurrency, and granting from your donor advised fund, also called DAF giving. Donors like you are making these types of gifts to the garden, and especially so at year end because these giving vehicles are often highly tax efficient. Our speakers will talk about several of these tools in detail today. So best of all, gifts to the garden can be designated to support the programs you deeply care about. This can range from research and conservation initiatives to education programs for all ages. Horticulture refers to the plantings and beautification of the trails, and exhibits includes festivals and special art exhibits like Chihuly, Botero, and this year's commissioned work, Frame Rate Desert Pulse. We love to know what aspects of the garden are meaningful to you, and we love to share the work being done across the garden, sometimes beyond what is visible out on the trails. For example, we have several projects planned for farther in the future that are still in quieter phases, like the Future Children and Family Garden, as well as special projects for specific needs that fall within these mission pillar buckets. At certain times of year, including right now through December 31st, your donation to the garden can be matched dollar for dollar to achieve greater purpose. All unrestricted donations made before midnight on New Year's Eve can help us unlock $125,000 in matching funds. However, The elephant in the room. When thinking about making a planned gift or asset gift to the garden, it is important to consider the timeline and the strategy, which is exactly why we are here today. Some transfers, sales, and documentation need several days or weeks to process. For donors in certain tax brackets, you may consider accelerating or bunching your giving in 2025. The clock is ticking. There are 26 business days until New Year's Eve. Luckily, I am glad to introduce our two experts who can explain some of these complexities, define some terms, and help you be prepared to make well-informed decisions and end the year strong. So it is my pleasure to pass the mic onto the wonderful friend of the garden, Shari Levitan, who serves on the garden's board of trustees as well as the Plan Giving Committee. She and her husband are decade-long members of Patron Circle and have thoughtfully communicated their plans to leave a legacy gift. She generously helped me organize this webinar today, bringing in her talented and equally philanthropic-minded colleague, Kara Howe-Santoro. I thank you both for being here today with us, and I will hand over the presentation to you.
Thank you very much, Olivia. I'm delighted to be here. I'm Shari Levitan, and what we're going to talk about today is that intersection between doing what feels wonderful, the giving part of it, making sure that your expectation as a donor is met and that the garden's expectation is met with your gift. And as Olivia mentioned, it's easy to send a check. It's easy to pay by credit card, but sometimes that's not the most efficient way to give. And we'll talk about making sure that you can get things done before year end because we're often relying on other folks, people at donor advised funds or at institutions where you've got your stock portfolio if you want to give appreciated securities. And they need time to make sure that things can settle and get credited for this year. One of the cardinal rules of charitable giving is that the charity, in this case, the garden, needs to receive the gift in 2025 for it to be counted for you as a charitable donation, which may be deductible for income tax purposes. There's a lot of buzz out there right now, though, and we figured we'd get the numbers part of this out of the way first and talk a bit about what happened in the most recent Tax Act, the One Big Beautiful Bill, sometimes called OBA or OBABA. It's got a lot of acronyms out there, but there's a fairly meaningful impact that has donors thinking, gee, should I do more in 2025 versus 2026? Will it make a difference on my tax return? And for some taxpayers, it may. So, Kara, would you like to share what the new rules are? A little bit dizzying, but the good news is you will have the materials to refer back to as a handy cheat sheet.
Yes, absolutely. Thank you, Shari. So the charitable income tax deduction has changed. So to start, we'll go over what it looks like for 2025, and then we will talk about how it will change for 2026. Olivia, could you go to slide 3, please? Thank you. So for many taxpayers, you might already take the standard deduction, which is basically a set amount that is set each year. It is adjusted for inflation each year, and it doubles if you are married filing jointly, filing your taxes jointly. And we have the 2025 amounts listed on the slide. $15,750 if you are a single taxpayer, or $31,500 if you are filing with your spouse. And so what this means is you can't take an additional charitable contribution deduction. If you give to charity, doesn't really matter how much you give, you just get this single deduction off your taxes. Now, there is one thing we just wanted to highlight for this year, which is the senior bonus. If you are 65 or older, there's an additional deduction you can take regardless of whether you take the standard deduction or what we call an itemizer. So somebody who itemizes their deductions, meaning they take a list of deductions. Next slide, please, Olivia. So starting in 2026, you'll see the amount for the standard deduction increases. And in addition, in 2026, taxpayers are allowed to take a charitable income tax deduction of up to $1,000 if you're a single filer or $2,000 if you're a joint filer. So all things being equal, if you take the standard deduction on your tax return, you might be able to take a little bit of a higher deduction in 2026 if you also give to charity.
And that
Next
means
slide. Oh,
January 1, right? You can do
exactly.
it anytime in 2026 and have that higher deduction limit if you do not itemize your deductions.
Exactly, Shari. Anytime during the tax year. So December 31, we're still in 2025, but January 1, it counts toward 2026. Next slide. So now we're going to get into really the nitty-gritty of if you don't just take the standard deduction on your tax return, but instead you go to your accountant with a list of expenses and you say, here, deduct all of these and figure out my tax bill. And so that includes folks who make large charitable contributions each year. They can take a deduction for what they give to charity, but there are limits as to how much an individual taxpayer can deduct against their income for charitable contributions. And part of that is based on the type of charity that the donor gives to, and part of that is based on your income, and part of that is based on the type of asset you give. And so we've provided a little cheat sheet for you right here based on asset that you give, type of charity, and you'll see it's broken down by private foundation or public charity. And just for everybody's edification, the Desert Botanical Garden is a public charity, so you're in that far right column, which is higher limitations. So this is what the charitable contribution deductions look like for 2025. In
And
2020,
and
oh,
it, before we move on, AGI is adjusted gross income. And so those percentage limits are for people who are very large donors. There is a percentage of your adjusted gross income. If you donate above that percentage, you're not able to take the full deduction. And that would be sort of a measure of the income that you have, adjusted gross income, versus an enormous donation. Most people do not butt up against those limits.
yes, that's a very good point. And so if you are a donor who makes large charitable gifts, for example, let's keep the numbers simple. If your income is, say, $100 in 2025, and you give $50 or 50% of your income to charity, and you give cash, then you can deduct up to 60%. So you're still good. You can deduct the full $50. But say you gave $50 worth of stock, you're limited to 30%. So you're able to deduct $30 in 2025, and then you would carry that extra $20 that you were not able to deduct in 2025. You would carry that forward to 2026 and try to deduct it in 2026. So there's a little bit of mental gymnastics and math that goes on if you give a substantial portion of your income to charity each year.
And just sometimes it's a little dizzying to figure out, will I be able to deduct everything that I think I can? And there's two ways to test that out. One, if you use a professional accountant, the accountant can prepare almost like a dummy income tax return. Say, assume my income is the same as it was last year, or maybe assume it's a little bit higher. And if everything else is roughly the same, but I make this kind of a charitable donation to the garden, what would that look like? And if you prepare your own taxes using one of the online programs or doing it by hand, you can do the same thing yourself. And it will show you whether you get all of the credit for the current calendar year or whether you have some in sort of a bucket that carries over into subsequent years.
That's right. So it's a little bit of mental gymnastics, but there are ways to run estimates. And next slide, please, Olivia. So now we're going to go over 2026. So 2025 was complicated enough. And then with the new tax bill, there are additional limitations that apply to your charitable contribution deduction. And so I guess to put it the simplest, um, you, because of these new limitations, on a dollar for dollar basis, generally you'd be able to deduct more in 2025 than in 2026. And the reason why is because there are two new limitations that will apply in 2026 that don't apply to 2025. So that chart we talked about, that will still apply in 2026. But in addition, there's a 0.5% floor on deductions for charitable contributions. So what this means is you essentially have to contribute more than 0.5% of your adjusted gross income to even take a charitable contribution deduction when you itemize. So again, back to our $100 of income example, if you make $100 of income in 2026, then the first 0.5% or 50 cents is not deductible. So if you give, say, $5 to charity in 2026, you can only deduct $4.50 because that first 50 cents is not deductible, or that first 0.5% floor. And this will apply in 2026 and years after that. Also, there's another deduction for all itemized deductions. So not just your charitable deduction, but if you take other deductions like a state or local income tax deduction or mortgage interest deduction or any kind of other itemized deductions, there's a limit where you'll only be able to deduct 35 cents per dollar instead of 37 cents per dollar. So if you're in a top income tax bracket where you're taxed at the 37% rate, there's going to be essentially a reduction in what you can deduct, and that applies to charitable contributions. So it will create a little bit of a haircut on charitable contributions in 2026 and years thereafter. So we provided an example here, if your head's not spinning already, where if a donor makes $1 million in 2026, the donor itemizes their deductions. That donor gives $100,000 in 2026 to charity. So we look at the first limitation, that 0.5% floor. Okay, so $5,000, which is 0.5% of $1 million, is not deductible. So on that $100,000 charitable contribution, you're starting at $95,000 for the deduction. But then there's also this limitation on the 35 cents per dollar. And so there's a way to calculate it out. In this case, you basically take this fraction, 2 out of 2/37 of the value of all of your itemized deductions. And that shaves down the deduction even more. So in this case, it shaves off another $5,400. So For a $100,000 deduction in this example, you're really only allowed to deduct 89,000, almost $600. So it's a very complicated calculation. Again, as Shari mentioned, if you either have an accountant that you can speak with, they can run a dummy calculation, or if you have your own, if you're going online and using tax software online, the software will automatically calculate it out. But just know in 2026, there are these additional shave downs that will reduce the charitable contribution deduction by a certain amount.
So, Kara, it sounds to me because these limitations all apply to itemizers, not to people who take standard deduction. So, if you're a standard deduction taxpayer, you said a minute ago, Kara, that you might get a larger deduction waiting until January 1 to make your charitable donation. But if you're an itemizer and you are a large, um, if you have large adjusted gross income, you may be better off if it's a significant donation doing it in 2025 and not be subject to all of these haircuts you've been mentioning.
Yes, absolutely. If you're looking to give and you're thinking, well, I'll just do it in January, you're better off, most likely you're probably going to be better off giving in 2025 and not being subject to all of these haircuts on the contribution.
Okay. So I see that there is a question in the Q&A. Is the limitation for itemized deduction 35 cents per dollar for all tax brackets, or is it 2% lower than your tax bracket?
So it's for all tax brackets, but affect um, it typically will affect people more in the top tax bracket, but it does apply to all tax brackets the way it's drafted.
But
And
the
it,
computation and the impact is really for those in the highest tax bracket.
yes, yes, but it will apply, the reduction will apply, and the floor will
Mhm.
apply as well to all tax brackets.
Okay. Well, now that we've had our head spinning, let's move on to the next slide. Okay. And how about the next one after that? Great. Okay, so what do we do if we're intending to make donations to the garden? And whether it's going to be a December, a November, well, we're almost at the end of November, end of 2025 gift versus a January gift. So, one of the neat things for taxpayers who are age 70 and a half or older is the ability to take what would otherwise be an income, ordinary income taxable withdrawal from an IRA account, and instead of receiving it directly, say, please pay up to $100,000 of it directly to the garden. And what that means is if you take a charitable, if you take a withdrawal from your retirement account, every dollar that you take out in most cases is subject to ordinary income, even if it was capital gain realized within your IRA or 401k. But you get a special benefit if you are 70 and a half or older, that each calendar year you are allowed to say, please pay over to this charity up to $100,000, the amount that you designate. And when you do that, you don't receive a charitable deduction, but you also don't recognize the income. It's just a wash. And it's a really neat way to get money over to charity without having to first recognize the income yourself and take a deduction, which is not a wash. If you do it this way, it is a wash. And that means that you can shift a substantial amount of money to charity, and the charity takes 100-cent dollars. They don't get any haircut for the income that wasn't paid, the income tax that wasn't paid. But the deal is, it's got to go to a qualified public charity. It can't go to your donor advised fund if you have one of those at one of the local organizations or a national one like Fidelity. It's got to go directly to a qualified public charity like the Garden. And there are a couple of other exclusions to it. I will say that if you're going to do something like that for 2025, again, no charitable deduction, but if you've got a required minimum distribution that you must take before the end of the calendar year, if you want it to go instead to charity, it's important to get those instructions out sooner rather than later to make sure it actually happens and you don't foot fault on it. Because if it doesn't go timely to charity, and if you haven't taken it yourself as your required minimum distribution, the penalties for failing to take that required distribution they're exorbitant. You don't want to be subject to those penalties. So be thoughtful about what you want to do and if you want to take advantage of these donations. Kara, do you have anything else to add on those?
Just that this is one of my favorite strategies because the distributions don't count as part of your income, they also won't affect your Medicare premiums, that new senior bonus. It's not going to, because there's a phase out on that based on income. So if you're looking to keep your income low for all of these other reasons, this is a great way to do it because it just never gets counted as part of your income. So it's really an awesome tool, particularly if you're in your 70s and required to take these distributions from your retirement accounts, but you're trying to keep your income low and you don't necessarily need the funds to live off of.
And you can do any amount up to the 100,000. So if going to 100,000 isn't quite comfortable and you'd rather do 50 or 60 and take the required minimum distribution for the excess, you can do that.
Yes, absolutely. You can take however much you want yourself and give however much you want to charity up to that $100,000 limit. And that limit gets adjusted for inflation each year. So this year, I believe it's up to 108,000 now, and each year the IRS adjusts it for inflation. And that is per person. So if you have a spouse who also has a required minimum distribution from their retirement accounts, you can double that. So it's per person.
And there's a question in the Q&A about whether this is a new provision. This is not a new provision, but it's been kind of a sleeper that the people who know about it have been taking advantage of it. And it's almost like it's a secret, and it shouldn't be because it's just a wonderful tool. All right, shall we move on to the next slide? Okay, let's talk about appreciated stock. And there's a lot of folks who talk about, gee, it's better to give appreciated stock. You bought shares of say, a public company for $10, and that stock is now worth $30. There's been an enormous run up in certain sectors of the stock market. And the question is, if that stock is worth $30 now, can you give it to charity and not have to pay the capital gains tax yourself? So you're not going to sell it and give cash. But if you give the shares directly to the Garden, does the Garden take the shares and you get credited with a donation of 30 instead of 10. Yes, subject to certain rules. So you can deduct the fair market value of the stock on the date of the contribution and not have to recognize the built-in gain or appreciation. And we're going to talk about what those rules are. And you can see in the example that the donor contributes 50,000 of stock with a basis of 10,000, very similar to my example a moment ago, on December 10 of this year. And the value is $50,000. Now, I'm just going to do a little aside about what the value is. The value of the stock is not the closing value of the stock on the day that you transfer it and the garden receives it. It's the average of the high and the low value that day. So if you've got a very volatile stock, you'll probably be in the zone of what you're assuming, but it may not be the exact number that you're thinking when you say to your broker, transfer $50,000 of XYZ shares. The value could be slightly higher or lower, depending on the average of the high and the low. So, Kara, do you want to take it from here on what the adjusted gross income is? And we'll walk through how it works and how much of that value you can deduct.
Sure. So if, in our example, if a donor makes $200,000 in 2025, they itemize their deductions. They contribute $50,000 worth of stock in December. And as Shari mentioned, that value is the average high-low of the day. Then the donor can deduct that $50,000 and doesn't have to recognize any of the built-in gain. So if your basis is really low, say you bought that stock 10 years ago, it's appreciated significantly. If you sold it, you'd have to pay a lot of capital gains tax. Instead, you can donate it to charity, never have to pay the tax on that built-in gain. And then you can take that $50,000 and deduct it against additional income that you already have. So, a few caveats on that. The first is that you want to have held the stock at least for 1 year. Um, the other caveat is that if you remember our chart at the beginning about the deductions, a donor can deduct up to 30% of their adjusted gross income when they give stock to a public charity like the garden. So there are limitations, and it's a lower limitation than if you're giving cash, if you're giving a very large portion of your income. So if you are giving less than 30% of your income in stock, you don't have to worry about the limitations. But if you're giving, half of your income away in stock, that's where you'll run up against the limitation. And in that situation, you can carry the deduction forward for up to 5 years, meaning you can use the amount that you can't deduct in 2025. You can use it against your 2026 income, your 2027 income for 5 years going forward.
I have found that a good source of this is sometimes people have inherited stock from parents or grandparents, or they got gifts when they graduated or got married and they sort of forgot about it. And it might be that unicorn stock. They have some shares of Apple that they got for almost nothing in terms of tax basis. And they've been hanging on to it because they know if they sell it, they're going to have to pay a lot of capital gains tax. Shares of something like that can be ideal for charitable donations because you get the credit and the charity gets 100 cent dollars and nobody pays the capital gains tax.
Yes,
And you will have held it for more than a year.
yes, those are the perfect candidates for stock gifts. So if you have any of that stock, that is the best, that's a really great strategy. Those are the best types of assets to give.
Okay. Let's advance the slides. So let's talk a little bit about the practicalities, because now you're scouring your stock portfolio and you find that you have those shares of low basis stock and you want to get the shares transferred. It can take a little bit of time to coordinate that with your institution that has your stock portfolio and the garden or any other charity that has a receiving account, because you need to give instructions on your end to get the shares transferred. And you're going to want to alert the garden that the shares are coming so that they're looking for them right away and can receive them timely. We are aware that a lot of the financial institutions put out early in November, sometimes in October, warnings that we need to have all of your instructions no later than X date, or we can't promise it will happen before year end. So you want to pay attention to things like that, because it's important that the shares actually factually transfer for you to be able to take the deduction. It's not enough for you to leave a phone message or send an email, which most stockbrokers can't pay attention to without confirmation, and say that instruction was enough to make it happen. The shares actually have to move. So you'll want to watch for the cutoff dates. And you'll want to, if you've got a volatile stock, you're going to want to work with somebody to try to, you can't always market time it, but to make sure that your expectations are met on what the donation will be credited for. You have
Yeah,
any
so
other
it's
comments about practical aspects, Kara?
yeah, just that, especially with when there's holidays and bank holidays in between too, it's really important if you're trying to either time the sale based on value or hit a cutoff date that, the first 2 weeks of December are things go much more smoothly. The last 2 weeks of December, things just seem to take a lot longer. If you put in a request on a Wednesday and the holiday is Thursday, Friday, it might get all the way to Monday before anything's actually happening. So just the sooner the better. And, if you're thinking of doing something the last 2 weeks of December, just really allow for a lot of extra time, because things seem to go sideways those last 2 weeks.
And here's another one. Sometimes you have paper shares in your safe deposit box. It's not sitting with your broker in street name, essentially, to transfer electronically. If you have paper shares, that will take a lot of extra time because you will need to sign what's called a stock transfer power and send it into the agent to get the shares physically transferred or get them into your stock portfolio if you have one. And you need to back up the timetable to make that happen. You can't just deliver a stock certificate to the garden along with the stock transfer power and have that be credited. Kara, any tricks for something like that that could cure something?
Just leave a lot of time and do it early. Like I said, first 2 weeks of December, everybody's still available. Systems seem to be running smoothly. So if you do have paper stock certificates, yeah, I would transfer them now. I mean, there are ways you can hold them in escrow um, if you have a broker or banker that you work with, they might be willing to, but again, it just you still need to sign everything and get it physically transferred.
Exactly. Okay, let's move on to the next slide. Kara, do you want to take donor advised funds? Because
Sure.
this can be a good intermediate parking lot.
Yes, very much so. So this is a really great strategy that really became popular when that standard deduction increased, 8 years ago. And I think even more so now, where we see the standard deduction continuing to adjust for inflation, all of these limitations on if you itemize the charitable deduction, that we just went over, that 0.5% floor, the 2% limitation. So it's called bunching. And how it works is if you give, say you give $10,000 a year to the garden, what you can do instead is you could put, say, 5 years worth of giving or $50,000 into a donor advised fund. And then you can take that one big $50,000 deduction in the year you fund the donor advised fund. So let's say it's in 2025. You say, okay, I normally give $10,000 a year to the garden. Let me put $50,000 into a donor advised fund in 2025. So in 2025, with this big $50,000 charitable deduction, you might decide to itemize your deductions and deduct that full $50,000. And then going forward for the next 5 years, you can recommend from your donor advised fund that a gift of $10,000 be made to the garden. And so in that case, in the years after 2025, so 2026 onward, you can either continue to itemize your deductions if it makes sense, or you can take the standard deduction. It doesn't matter because you already received your charitable deduction up front in 2025. So a lot of folks will lean on donor advised funds. They'll open up an account and they'll fund it every few years so that they can take advantage of the charitable contribution deduction, and it helps to even things out. If you think about, say, you're right on that cusp of do you take the standard deduction, do you itemize? It really helps to help you maximize that charitable contribution deduction.
And the donor advice fund is itself a public charity. So on those deduction limits that are on the chart, you get the ones on the right-hand column. The same as if you gave it all to the garden. But if you are intent on parsing it out, a donor advised fund can solve that deduction issue and let you still control the timing.
Yes, that's right. And of course, if you wanted to just give a large amount every few years, there's nothing stopping you from giving, say, directly to the garden. It's just if you like to give a certain amount each year and spread it out, the donor advised fund helps you to do that. Next slide, Olivia. Thanks. And here's an example too, just to show you the numbers of how it works. So say for the next 4 years, starting with this year, taxable income is $300,000. So if you were only to take a charitable contribution deduction of 10,000 each year, depending on what your other itemized deductions are, it just might not make sense. You might still just be taking that standard deduction. So you really kind of lose out on the charitable contribution deduction. But if you accelerate and put everything into a donor advised fund, that $50,000 in 2025, you'll see you have a $50,000 charitable deduction for 2025. Maybe every other year you have 20,000 in itemized deductions. So in 2025, you can deduct $70,000. But then going forward, say you'd only have 20,000 in itemized deductions, well, the standard deduction, if you're married, is 32,200. So you're better off in future years to take that standard deduction. So you lose out on your other itemized deductions, but this is a way that you don't have to lose out on the charitable deduction.
That's excellent. Bunching. Who would have thought? Okay. Here's one that we use very often which are beneficiary designations. And this is sort of a longer range plan. It's not an immediate plan, but when you leave retirement accounts to individual beneficiaries, your children, for example, your grandchildren, they will pay income tax from $1 on every amount that they receive. So a bequest of $50,000 coming through a retirement account is not $50,000 in their hands. It's 50,000 less the income tax. And there are ways to stretch out a bit, not as favorable as there used to be, when they have to take money out of the account, but they still will pay the income taxes on every dollar received. Whereas a public charity or a private foundation will not pay the income tax. They get to keep 100-cent dollars. So leaving retirement accounts to a charity is an ideal way to shift the dollars from the government to your favorite charity for your retirement account. The only thing that we really caution about with retirement accounts is that you don't commingle individuals and charities as beneficiaries for the particular retirement account. It would be better to break the account into a couple of separate accounts, leaving 100% of one to charity and the rest to people, if that's what you choose to do, because leaving some of an account to charity can limit what the individuals can do for planning with the retirement account. We're also cautioning not to leave retirement accounts through your will or your trust if you can avoid it, even if everything goes to charity or part goes to charity. There's some recent rulings that are a little uncertain about making sure that there's full credit for the charity. And you have to be oh so careful if you're going to make sure that that's done properly. Easiest if you designate the charity outright as beneficiary. Same thing with transfer on death, or TOD or POD, as they're sometimes called, brokerage accounts, bank accounts, life insurance policies. You can name a charity as the beneficiary of those sorts of things. And it's very easy. You don't need a special document done. You just name the charity, and you're done. You can also name the garden in your will, in your revocable trust with a charitable bequest, which could be a dollar amount or a percentage. It's very important if you do that, if not everything is going to charity, and if you have a sizable taxable estate. Arizona has no state estate tax, but there could be a federal estate tax for a large estate. It's important to make sure that you work through with your attorney who will pay the estate taxes. Because if you allocate some of that responsibility to the charity, it can have an unintended tax consequence to it. And now I want to focus a little bit on charitable trusts and gift annuities, because these are things that can benefit both people and charities. Kara?
Sure. So charitable trusts and gift annuities basically allow you to contribute a certain amount to either the trust or the annuity, and then you get a stream of income back. And that stream of income back can be for a term of years or for the rest of your life or the life of you and your spouse. And so it's a great way if you have assets and you want to get an upfront charitable contribution deduction. And typically, the charity might handle, particularly with the annuity, they'll handle the investments, and you would be guaranteed a stream of income back. So on the annuities, on day one, you'll know what your annual payment is going to be. And you'll know if it's for a term of a certain number of years or if it's for the rest of your life. You'll know that you're guaranteed that annuity each year. And so it's great because, say, for example, in 2025, you set up a charitable gift annuity. Maybe your income is a little bit higher in 2025. So you can use the income tax deduction in 2025 when you set up the annuity. You'll get this stream of payments back for your life, and the charity will get whatever's left over at the end of the term or when you die. Now, the payments that you receive on an annual basis will be taxable to you, but they'll be spread out over time. So it's a really great way to, if you aren't necessarily willing to part with the income yet, or maybe you need the income to live off of, but you also want to give something to charity and make sure something gets to charity, it's a great way to do both, basically. The charitable trusts operate similarly, but the payments might vary from year to year depending on what type of charitable trust you set up. A popular one that you might have heard of is called a charitable remainder trust. And it operates similar to a gift annuity where you put the funds in, you get a stream of payments back over time, and whatever's left over at your death or at the end of the term goes to charity.
Okay. And there are other sorts of things that the garden can work with you on. We have taken in donations of land after discussion about whether the particular donation would be appropriate and whether it works for both the donor and the garden. We always find that if it's not just a straightforward donation of cash or securities, that having a conversation makes a lot of sense so that we can understand what your intentions are as a donor. You can understand the way that your donation will facilitate the mission of the garden and make sure that everything is working because this is a really happy event. Out of all the things that tax planners do, making sure that expectations are met so that it's purely positive is the best outcome possible. We are happy to take questions if you have any at this point. Olivia, is there anything that you think you'd like to ask of us or make the listeners aware of?
There is. I want to make sure that you can see my screen again.
We can.
Okay, and thank you for bearing with me, for asking you questions and for being the technical director today. Let's see if I can get us back to current slide. Folks, please know that you are welcome to continue asking questions in the chat at this time. I do have some of those questions of my own, so here we go. Actually, Shari was beginning to talk about this. And so again, feel free to drop any other questions into the Q&A feature, and I will address them in just a moment here. But a few programs that I would like you to know about. To state for the record, we know that folks do not give to charities for tax purposes solely. You give because you love the garden and you want it to thrive. So it is our pleasure and our joy, and frankly, our job to thank donors for your generosity by offering engaging, creative, and welcoming programs that continue to inspire and grow a love and appreciation for the desert's beauty and resiliency. So two of those donor programs I want to highlight today are Patron Circle and Sonoran Circle. Patron Circle is a membership level that we think of as philanthropic at heart. It's for those who donate at least $1,500 annually. Favorite benefits and activities beloved by donors include unlimited member and guest admission, so you can return to the garden again and again in all seasons, invitations to special programs like the beloved annual Luminarias Party, early shopping at the plant sale, and advanced previews of new art exhibits. And unique to Patron Circle is our excursions program. We offer small group, highly curated trips to exquisite regional and international sites with nature at the focus. We've traveled to the Galapagos Islands last year, as well as Washington, D.C. and Tucson, and we're headed to Ireland in the spring with some spots still remaining. So additionally critical are gifts made to impact generations of desert dwellers to come, well beyond your and my lifetime, what we call legacy gifts, gifts made in wills, trust, and beneficiary designations, as were discussed previously today. This is just naming a few. These donations require forethought and planning and may cost you nothing today to put into effect. So we warmly invite legacy donors to join Sonoran Circle so we may recognize you today and in perpetuity for such thoughtfulness. There is no minimum donation to participate, and you often have complete authority to change your mind should life alter your plans. If there's no other questions about this, I will also say,
I see a couple if we have just a moment,
oh,
Olivia.
perfect.
So
After,
one was
oh,
one
sure.
was will the recording be sent to us? Yes, I understand that is the case. Another question was, is the estate tax only a concern if it is over many millions of dollars, no matter whether the recipients are charitable organizations or individuals or a mix? That's a very good question. Starting January 1, 2026, the federal exemption from estate tax is $15 million, 1-5, less any amounts that you have already used during your lifetime for taxable gifts, gifts to non-charitable beneficiaries. The estate tax may not apply at all, even for very large estates that are left, say, entirely to charity, but there still will be a filing requirement to show what the gross estate is and what the deductions are, because we do have an estate tax charitable deduction that is not subject to these income tax limits. So an estate that goes entirely to charitable will be non-taxable, but may have a reporting requirement.
Thank you for your question. Thank you, Shari, for answering.
Mm-hmm.
Please do keep it coming. That is totally fine and welcome. So I will say that what you're seeing on this slide is that to learn more about estate planning and charitable giving of non-cash assets, you can visit our website. It is dbg.myplannedgift.org. Also, as mentioned, thank you very much for mentioning this. Time is ticking. I want you to know that the garden and our development offices are open 9 a.m. to 4 p.m. and only closed on Thanksgiving Day, Christmas Day, and New Year's Day. We have somebody in the office 7 days a week. The same hours will apply on New Year's Eve. So please be in touch if you have questions about the timing and impact of your gift in 2025. So, because I really don't see anything else coming in, I want to say thank you so much for attending. It has been such a treat to have you both, Shari and Kara. Your wisdom, your knowledge, and your experience is just second to none. So thank you, especially during your busy time of year. And then to all of you on the webinar who are dear friends of the garden and ceaseless supporters of desert plants and our blooming cultural center at Desert Botanical Garden, thank you for spending your time learning with us. From all of us at the garden, we wish you happy holidays, and we hope to see you out on the trails very soon. Thank you.
Thank you.